Hello, everybody, and welcome into commodity culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day. Today is December 11th, 2025. And before we dive into today's interview, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today I'm joined by Kristof Gleich, President and Chief Investment Officer of Harbor Capital, and Don Casturo, founding partner and chief investment officer of Quantix Commodities. We're going to dive into how both companies approach the commodities sector, along with talking about the macro for gold, silver, and a whole lot more. Gentlemen, it is great to have you on the show.
Jesse, great to be here.
Yeah, thank you, Jesse. Looking forward to it.
I am as well. I want to start by getting your thoughts on the gold market. The metal has had an unbelievable year, breaking out to new all-time highs, now sitting at around $4,200 an ounce. What do you see as the main catalyst that got us here? And do you think we're closer to the beginning or the end of this bull market? And Don, I'll go to you on this one.
Yeah, sure. The main driver that got us here, basically, it started in 2022 with the Russian invasion of Ukraine that started a de-dollarization trend among global central banks. And you can see a notable uptick in central bank buying from that date as reliance on the US dollar as a reserve currency started to become questioned. And as a result of that, the move from basically 2000 to 3500 was pretty steady, and there was always a consistent bid coming from central banks. In any market environment, they're a very stable investor, don't react with the same emotions as maybe an individual investor would react, and that steady buying had a very non-volatile path basically from 2000 to 3500. This de-dollarization has expanded, I would think, into a general institutional credibility question that has now even brought in the retail investor, and particularly with rates coming down, there's not nearly as much of a fear of like losing out on the fixed income gain that you have no positive cash of holding gold. That has become less of an obstacle with lower rates. Plus the fact that is it even appropriate to lower rates when we haven't fully combated inflation in terms of its original target, is putting more institutional credibility in question, and that has now brought in the retail investor for the last $1,000 in the gold move. The retail investor, because they're a little less stable, has meant the price path has become a little bit more volatile, but it is still an upward trend, and we believe that we are still relatively early innings in terms of how far this can go, particularly if you compare to the gold move in the 1980s that was driven by a same de-dollarization institutional credibility thing then, and the scale of the move from start to finish in the late 70s into 1980 would suggest that a $10,000 price is possible. That would be the equivalent of the 850 that we hit in 1980 relative to the $200 starting point 2 years earlier.
Yeah, some very good comments there. Christoph, anything to add?
Yeah, I just said largely agree. I think we're in a structurally different environment than we have been post GFC. 2020s has proven to be a very, very different decade. And this notion of debasement is real. We believe it's got much further to run, as Don suggested. And I think the interesting thing about next year, look, it's always hard to predict forward 12 months, especially after gold's had such a great run this year. But we know something very interesting about next year is we are going to have a new dovish Fed chair, and that is indisputable. And we're going to have a dovish Fed chair coming in, potentially colliding with an economy that is accelerating, and we're going to have an economy that is running hot and potentially overheating. At the same time, you're going to have an incoming dovish Fed chair. And again, that combination and that setup could be very interesting next year.
Yeah, I was actually just thinking that as well. The fact that there's probably going to be more rate cuts up ahead. We are seeing the death of Fed independence, in my opinion. Not that it has ever really been truly independent, but now we're seeing Trump install a Fed chair who is probably going to be following his orders on rate cuts. So we're in very interesting times in uncharted territory. I want to talk about silver as well, which has also hit new all-time highs and gone up over 100% year to date. I believe Right now it's trading around $61, $62, obviously a much more volatile metal than gold. Does that make you cautious at these levels? Because I'm hearing calls for triple digit silver all over social media. And when we consider its inflation adjusted price, especially if we go back to the 1980 high of $50, is indeed around $200 today. What are your thoughts there? Should investors be considering silver for their portfolio at these levels? Don, I'll go to you on this one.
Yeah, I think there's still potential for significant upside in silver. You gave investors the appropriate caution. It is a much more volatile underlier than gold, but that's partly why it has so much more upside potential. It's on a dollar basis, it's 1/9 the size of the gold market. Both of those commodities, if you're talking about investment demand, are not something you can measure in usual supply versus demand consumption models like the rest of the commodity markets. It's very sentiment driven. And if you have one market that's 1/9 the size, but just as many people to have the sentiment to want to buy it, in order to satisfy that, the price moves are going to be much larger. And consistent with how I was answering the gold question, when it was central bank buying, central banks are much more conservative and predominantly only put gold as a precious metal in their asset mix. And as a result, in 2024, the move from 2,000 to 3,500 in gold saw gold outperforming silver. The gold silver ratio went from a historic average around 80 up to 100. Now that the second phase has brought in the retail and speculative investor who can largely substitute gold or silver wherever they think the better opportunity is, when they saw that $100 long-term gold silver ratio and thought that silver was undervalued, have massively come into silver, pushing that ratio down to 60, but still 60 on a 30-year average basis isn't overstretched to the downside. And if there's just as much sentiment to buy silver and it's a smaller market, you could have much larger moves as a result of that.
Let's talk about base metals. I'd love to get your thoughts on copper and nickel. Copper especially has been in the spotlight recently. It had a very interesting year, rising to all-time highs on announcements that copper would be tariffed and then falling down dramatically again after those copper tariffs ended up not being as widely implemented as people were anticipating. What are your thoughts on the copper market? Nickel, another very interesting metal that could be in the bottom of the cycle. Potential uptrend could be unfolding there. And any other metals you're watching that you think present an opportunity, Don?
Yeah, I think picking copper and nickel to ask about is interesting because there's been a fair amount of dispersion in their performance this year. You know, with copper being the best performing of the base metals and nickel being the worst performing. I personally don't look at nickel's underperformance as a value buy opportunity. I think there's some structural things in place that have contributed to that dispersion that are likely to remain in place. Nickel is having is less relevant in the battery space than it used to be, with some substitute technologies that's removed nickel from that thing. Obviously important relative to steel, but the main growth in terms of metal demand isn't coming from manufacturing and expected steel consumption. It's more coming from power consumption on the back of AI usage, and nickel is not that relevant to that story, where metals like copper and aluminum much more so, and I think that is likely to still continue. In terms of copper performance this year, you touched upon tariffs being a big driver and the differential between COMEX US-based copper and LME non-US based copper, and the tariffs being responsible to driving the differential between those two otherwise fungible products to record levels, and then coming back off when the announcement that it would not apply to copper cathode. There's still the expectation at some point forward that the tariffs are going to happen. So there remains a premium to US-based copper relative to the rest of the world, which is basically attracting all copper inventories to the United States and creating a genuine shortage, very tight markets offshore. The LME copper is actually in backwardation because storage levels are so low, and that is actually signaling an investment opportunity, because if you can buy and hold something and actually get a positive roll yield, that's an attractive thing for commodity investors, and that is the case now for LME copper. We think that, coupled with the demand story coming from electrification, some supply issues coming out with three of the largest producers revising down their forecast for production next year. That's putting the market in a visible deficit. Has us remaining more bullish copper than other base metals.
Great summary there. What are your thoughts on the critical minerals question? Because obviously this has been in the headlines recently, particularly rare earths with China export controls. The US recently adding silver to the critical minerals list, along with a number of other commodities. I believe uranium is on there as well. We're witnessing a moment where we're seeing export restrictions in many commodities, as we were just speaking about nickel. Indonesia as well, of course, restricting exports of raw nickel. Only processed is allowed out of the country. And there seems to be kind of a global awakening when it comes to the importance of commodities and hard assets. How does that all play into the picture in your view? And which metals and commodities do you think stand to benefit most?
So I expect Kristof to jump in here with a deglobalization part of his answer, because what you're alluding to here is a genuine deglobalization that is structurally very important to commodity markets. Basically, for almost 2 decades, maybe 3 decades, really, the world was in a globalization phase, which created inefficiencies in terms of supply chains, and commodities are basically at the heart of supply chains. And the efficient movement of commodities from region to region was a very much a deflationary aspect, because the world was getting the stuff it needed from the cheapest place it could create these things. As we move to deglobalization, there's going to be inefficiencies that are introduced into the process. And on top of that, probably strategic stockpiling, because you're worried about not being able to get it from a friendly neighbor like you used to be able to, all of which is supportive to the price of all of basically every commodity. I mean, specifically, like which ones do we believe have the most upsides? You mentioned the specialty metals. The issue with specialty metals from a commodity investment manager's perspective is they're difficult to invest in. From a commodity price perspective, there's not liquid futures because they're relatively small markets and they're inappropriate for futures contracts. That's the majority of the type of investing we do. There are OTC contracts you can invest in, but it's on such a small scale. It's hard to actually make a product that you could market to other investors to get involved in. As a result, commodity equities are probably a more attractive way to get exposure to that space. That's not what we do here at Quantix, but for your general listener, someone who specializes in commodity equities is probably a better way to get that exposure.
And Don sort of teed me up there, so I'm sure your viewers, or some of them, are familiar with that Jim Carrey movie from the 2000s, 23, where he's obsessed with the number 23 and he sees it anywhere. I find myself doing some version of that, but with the letter D in commodities. And so just more broadly, I'm going to make the case for commodities. I'm only going to use words beginning with the letter D. You ready?
I'm ready.
All right. Different decade, debasement, doves, debt, deficits, defense, data centers, deglobalization, decarbonization, and diversification.
I love it. That sounds very accurate to me. Could you give us your broader thoughts on the deglobalization aspect of that, as Don was alluding to, and how you think that might drive the thesis for commodities?
For sure. So, we've really in our careers, collective careers, we've been in a world where economic incentives driven by increasing globalization have driven efficiency, economic efficiency. Where is the cheapest place where we can manufacture or create whatever we're trying to build? And there's been a huge reliance on global supply chains, just-in-time inventory, and that world ended when COVID was ushered in. And COVID came at the same time as a number of other trends, just increased politicization in local and in global politics, leading to more fragmentation. And so if you look across the world in every single country is now looking inward rather than outward. And that's leading to, policy that is encouraging, onshoring, nearshoring, security. And when you look at all of that, it is unequivocally inflationary because the economic interest is no longer the driver. It's being driven by non-economic factors. And so I do think over the next 10, 15, 20 years, it is likely there's going to be this deglobalization, which is going to be inflationary and obviously bullish for commodities as a backdrop.
Well, let's dive into your strategies, starting with Quantix, because there you have a unique approach to providing broad basket commodity exposure. Can you walk us through that framework and explain how the Quantix Commodities Index plays a role, Don?
Yeah, let me just
Oh,
quickly
sure.
give
Yeah,
a
yeah.
bit of context on that because I think, and then I'll pass over to Don. So we have an ETF. The ticker is Hedger, HGER. It's available. It has very good volume, very good performance, which we'll sort of talk about. Underpinning that ETF is the index that Don and the Quantix team created. The reason that we at Harbour wanted to launch and find a specialist to run a commodities ETF, a number of the reasons I talked about, we were bullish, on the asset class. But we also, after a significant amount of research and market research, concluded that investors have been underserved by commodity solutions available. And frankly, a lot of investors don't own commodities because of the poor investor products that have existed that have led to bad investor outcomes. We felt passionate about improving upon that. And that was where the partnership with Don and Quantix came in to create what we think is really something that's quite special. But Don, I'll pass over to you.
Yeah, basically what Kristof is describing is what they recognized as the gap in terms of investment products in the commodity space is completely aligned with what we were trying to do at Quantix. And I also recognize in a 30-year career in commodities that the existing benchmarks were not appropriate investment vehicles for the investor. And there's a rational reason for that. The GSCI and then later Dow Jones and AIG index, which has now become BCOM, were created originally to provide the offsetting exposure for bank swaps desk producer hedging. So they were naturally sort of weighted in a global production weight because that looked most closely like the offsetting exposure they needed, to balance their books from producer hedging. That is, those indices have been used to show in many cases, especially with idiosyncratic supply shock, inflation, scarcity-driven deflation environments, to be effective as an inflation hedge. But they weren't built to be an inflation hedge. They were built for this offsetting risk exposure dynamic, and then marketed as a potential inflation hedge. When we started Quantix, the first thing we tried to set out to do was like, well, what if we were to try and design a basket that was meant to be what the investor meant to match what the investor objective was, which is an appropriate inflation hedging vehicle of a broad basket of commodities. And that was basically our governing principle and the investment thesis that we were trying to solve for. Using the same commodities, our index uses the same universe of 24 commodities that BCOM uses, but we weight them in different ways, and we have different criteria for looking about what's appropriate for their inclusion in their relative weighting with the investor objective of mind of hedging inflation. And to do that, there's a couple of key principles we consider. One is that the commodities that make up the BCOM index have a wide range of refinement, some of which are much closer to end consumption than others. And if you're driving inflation, the one that's closest to what the consumer is actually paying for something should have a higher weight. And a simple example of that, cotton that trades in the index basically is coming right off the bale. Like, it needs a lot of refinement to turn into a product that anyone uses, even in a t-shirt, which is like one of the most basic uses of cotton. It's only the cotton in the t-shirt is 5% of the price. So cotton prices could double, not really inflationary to the end user. RBOB gasoline, like what we trade at the index level, is basically the same stuff that you put in your tank. If that price changes, you're going to feel it. So that considerations on quality score metrics like that to consider inflation sensitivity were a key element to our process. And the other thing is the cost of maintaining that position. As you're probably aware, Jesse, like you in commodity indices, you own derivatives. You don't actually physically own the 24 different commodities. You own the futures contracts that are tied to the price of those commodities. In order to maintain that exposure, you need to roll from one future contract to the next. If the market is in a state of contango, i.e., the future price is higher than the current price, the investor doesn't actually get that gain when the price goes up. That's paid away in roll yield. And if you do that repeatedly in a contango environment, the cost of holding that exposure can become quite prohibitive. And you need to consider that if you're designing something that an investor wants to use for a long-term strategic allocation. Those two elements contribute to a quality score in our weighting process that create a much more appropriate index for investors. And the last element, critical element that we put in our process is, and this is based on my years of commodity experience, even at the bank I previously worked, when I would talk to investors about why, what kind of a commodity exposure do they think they want to hedge inflation, half the universe would say gold and half the universe would say oil. I always thought that was very curious because those commodities have completely different characteristics, yet half the universe would use one, half the universe the other. And when I sat back and thought about it in designing what our index should look like, it occurred to me like they're actually talking about different sources of inflation, different environments where there are actually a different catalyst, which is probably the bigger driver of an inflationary impulse. One, if you're buying gold, you believe in just general debasement, what like Kristof was alluding to earlier, where if every commodity that are in the BCOM index or our index is denominated in the US dollar, but there's a view that the US dollar is not going to be as powerful going forward as it is now, you want a store of value. And gold is the really only commodity that is meant to be a store of value. Every other commodity is meant to be produced and consumed and produced and consumed. It doesn't even make sense to store. Like to store $1 billion worth of oil, you need a football stadium. Like that's not an efficient thing to do with it. You're supposed to use it. But there are environments where oil is the right answer because there's not enough of it around to meet the demand of a hot economy. And those environments, you're actually getting backwardation in the price curve. So rolling from the front contract to the next to maintain your exposure, you actually get a pickup in roll yield. You get a positive roll yield. And there are environments where oil is the more appropriate hedge. So the right answer for a long-term strategic allocation should have dynamic reweighting that considers that. And that's the last key element of our Quantix index process that recognizes those different environments and dynamically reweights appropriate.
And you can see like Don is very passionate about commodities, which is what, one of the many things I love about Don. But what we don't get to do very often in our industry is create a new benchmark. So this is what we're trying to do here is like we're trying to create the new S&P 500 for commodities so that investors get the type of exposure and experience from commodities that they deserve to help diversify and enhance returns for their portfolios in clearly what is a different environment that we've been in for the last 50 years. So I think it's super cool and super exciting.
Yeah, well, Kristof, we'll dive into some more details on HGER, the Harbor Commodity All-Weather Strategy ETF, obviously constructed based on the Quantix Commodities Index that Don was describing. Walk us through your thought process with putting this product together. And you mentioned you would like it to kind of reflect the index as the new S&P 500 for commodities. Talk to us more about that.
Sure. So look, when you sit down with clients, a typical response or conversation that you might have around commodities is, I don't hold any. I've been there, tried it, and hate it. And what a lot of experience that allocators have had with commodities is they may have dabbled with them in the 2000s, 2006, 2007, and then coming through the financial crisis and then obviously into this sort of decade of very low growth and very low inflation, just had very disappointing returns. And so they got out of them and they never went back in them. So you're fine. That's your starting point. The second thing is you have to, I think, meet them where they are. Like you are right to not hold commodities for the reasons that you've pointed out. Then when you take a common index like BCOM, by the way, nothing against Bloomberg or their indices, great company, but BCOM is today the S&P 500 of commodities. And then you look at the long-term, case for including commodities anchored to the BCom over the last 25 years, you have to kind of squint, tie yourself into a pretzel, extend to like 5 decimal places to kind of see some kind of diversification benefit, correlation benefit. And so we wanted to fundamentally rethink the asset class. And we concluded that commodities were not the problem. The way that they were being combined and delivered to clients was the problem. So now by creating this index, the index is now 4 years old. The ETF is 3.5 years old. But the index returns for the rules goes all the way back to year 2000. Is it, Don? 2000, early
Yeah,
2001. I think, yeah. And you can see
2001.
by 2001, by doing any kind of efficient frontier analysis, by including the index or including hedger in a 60-40 portfolio, call it a 60-30-10, because typically people view the 40 as the diversifiers to protect, to zig when the market's zagging. We think commodities does that even better than bonds, especially in this environment. You can create a meaningful difference to returns over the long run, last 25 years, 1% per year with no real pickup in vol. That's really meaningful. If you look at what it's done this decade, for the same level of vol, doing a 60-30-10 with hedger, it's about 200 basis points of extra annualized return, which obviously is very meaningful. And so that's why we sort of feel so passionate about creating this new index, creating an ETF that tracks it, getting our story, out there, and hopefully more clients' portfolios can benefit from a thoughtful allocation to commodities. Now, look, it's not always going to work in every single, market cycle, but we do believe that this is an enhancement and should potentially result in a sort of a smoother ride and a greater compounding for investors.
Quantix also offers Quantix Commodities Alpha, which is described as an all-weather relative value strategy seeking to generate positive risk-adjusted returns across all market environments. Can you explain how that differs from your broad basket long-only strategies?
Yeah, sure. I mean, the long-only strategy, as the name of as that description implies, is 100% invested in commodities at all times. It has 100% beta to the commodity market. The QCA strategy, the Quantix Commodities Alpha strategy, is a relative value absolute return strategy that Quantix also runs for investors. And its broad investment thesis is that there are inefficiencies in the way market participants interact with commodity markets. And having a good understanding of how their different investment objectives creates distortions in commodity price curves, and in addition, the actual fact that there is price curves, that it's not a single asset like there is in equities. There's a curve of prices that has some interaction and what should be a fair value interaction between those commodity futures contracts that sometimes get distorted by the inefficient participation of the market participants. That's what we're trying to capture within our relative value strategy that is QCA.
And moving back to Harbor Capital, you guys also have a wide range of ETFs outside the commodity sector, emerging markets, dividend growth, real estate, a lot more as well.
Yeah.
Kristof, could you highlight a few that you think are particularly relevant to our current market environment?
Yeah, so obviously we talked a lot today about hedger. I passionately believe that's a great way to enhance, portfolios by inclusion there. I'll mention a couple. I think if you look at a 60-40 portfolio today and you look out 10 years, 60-40 portfolio returns are going to be pretty low over the next 10 years. Starting valuations in equities and yields for the rate environment and type of inflationary environment that we may face, I don't think a 60-40 portfolio is going to generate strong real returns after inflation. If you look post financial crisis, 60-40 portfolio for about 15 years did 10% a year with 2% inflation, you earn 8% real returns. What's not to love about that environment? Sadly, I think this environment going forward is different. So that's number one. So therefore, I think alpha is going to be more valuable than beta. I think it's always more valuable, but I think it's especially going to be more valuable. And I do think with this AI technology, boom that we're going through at the moment, has got a lot of legs to run. In terms of, I do believe that we're only just very much at the beginning of the adoption curve in how we integrate AI into our lives, our working lives. We haven't even really thought about, redesigning workflows and things like that yet. It's all about incremental enhancements and efficiency. So I do think the technology is for real, and I think that's going to create sort of this K shape of winners and losers, and you're going to have a lot more dispersion. And so the ability for skilled stock pickers to add returns to your portfolios is going to be better going forward. So a couple of ETFs I'll mention quickly. The first one, the ticker's TEC, TEC. That is a technology-oriented ETF that is focused on this technology transformation I just talked about. It's run by Jennison Associates up in New York. Very, very skilled long-term stock pickers in secular growth and in technology. They have a 50-year history of doing this, and we know them very well and think very highly of them. And then number two is MEDI, MEDI, which is, surprise, surprise, a healthcare ETF. And again, this is run by a different firm up in Boston called Westfield, founded by Will Musier. He's a healthcare investor, very skilled stock picker. And again, we think the healthcare sector, partially but not exclusively driven by a number of these developments that are going to happen as a result of AI, is going to be a very interesting place where you can add significant sources of alpha-oriented return to portfolios. So I think those are maybe a couple that are a little bit different, sort of nice satellite positions for hopefully for some of your viewers for their portfolios.
I want to talk about an article that Quantix released titled "The Impact of Rearmament on Commodity Markets." I'm going to read a quote here. An emerging theme in 2025 is global rearmament, part of the broader deglobalization movement. If the world returns to a 1980s level of global defense spending, 4% of GDP, Quantix estimates a spending increase of 1.7 trillion annually, leading to a rise in ongoing commodity demand. I'd love to get both of your thoughts there on which commodities that you think will be most impacted by a boost in global defense spending, and how Quantix and Harbor Capital investment strategies plan to take advantage of that. Don, I'll go to you first.
Yeah, this is another one of Christoph D's defense and how that fits into the commodity story. From absolute supply perspective, there are two base metals that would likely feature most prominently in an increased defense spending. That's aluminum and copper. There are some minor metals that on a percentage of underlying demand perspective, it's probably more impactful. But again, that's difficult to. Those markets are more difficult to invest in. The biggest pushback we get when I say aluminum and copper, they're like, well, the percentage of absolute demand that is attributed to defense is so small that doesn't matter. But that's missing the point, because in commodity markets, it's the marginal ounce or ton of consumption that sets the price. And the marginal incremental demand that's coming from defense is what now pushes those markets from balanced or maybe small surpluses into deficit. So this defense catalyst actually is quite meaningful in terms of what it could mean to prices.
And Kristof, your thoughts on defense and how it could drive your investment strategy.
Look, I'm going to agree with Don. Don is the real commodities expert here. What I would say is, in terms of that sort of the base metal view, if I had to own one base metal and disappear off to a desert island for 10 years and see what happened in 10 years' time, it would be copper. For all the reasons that Don said. It's such an important base metal, and there's so many things going on in the world at the moment, including obviously defense spending, that is going to just increase the demand and the demand supply imbalance in copper. Copper, I think new copper mines take 15 years before they go from greenfield to really producing. Maybe we can cut that short by a year or two. But I think it's going to be a real problem for the world in terms of copper pricing potentially becoming sort of almost like the new oil in terms of like the inflation basket, and the overall society's sensitivity to copper prices could ultimately replace the role historically that oil's played in that respect.
Well, for people who want to follow your work, get more information about the products and services you offer, where's the best place to go? We'll start with you, Kristof. Would it be the Harbor Capital website?
Yeah, so harborcapital.com. We've got tons of information, insights. I'd urge people to check out harborcapital.com/the current. That's our weekly guide to markets, and we've got plenty of cool stuff in there around commodities, and sign up for subscription. And then we've got information on our ETF, specifically Hedger, and obviously Tech and Medi, the ones that I mentioned. And I'm also reasonably active on LinkedIn. And luckily, because I have such an unusual name, first name and last name, there's only one of me on LinkedIn, so I'm pretty easy to find.
Great. Well, I'll put all of those links in the description. And how about yourself, Don, with Quantix?
Yeah, similarly, our website, quantixcommodities.com. We can find all relevant information and how to get a hold of us for more detailed stuff if you need it.
Great. I will put that link in the description as well. Gentlemen, this has been a fantastic and far-reaching conversation on the commodity space. Greatly appreciate you both coming on.
Thank you so much, Jesse.
Yes, thank you, Jesse.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.